This is the second installment of our two-part series on capital. In part one, we looked at net present value and interest rates and understood how interest rates come about through time preferences. In this one, we're going to use the interest rate and what's weighted average cost of capital in order to apply this to acquisitions. So we looked at a consol, and we said that a consol is a great way of determining the present value when you have a constant stream of payments over time. And instead of putting down each present value formula, 100 divided by 1.05 to the first, plus 100 divided by 1.05 to the second, plus 100 divided by 1.05 to the third, on down to say 50, this is a shorthand formula that would give you the same answer. So A would be the annuity value, that's the constant stream of payments, in this case $100. R is our interest rate, 5%, and T is the time period, the number of payments we will receive at the end of each year, or the end of each period, depending on what it is. And this allows us a much easier way of calculating the present value of this constant stream. One thing we want to look at is the dividend discount formula. Suppose you had a company that paid $1 dividends at the end of each year, and the interest rate is 8%. Well, what should a share of that company stock be selling for? Now, again, this is a very simplified version. There are a lot of other things to look at in evaluating a firm. I'm just assuming that the only thing we're looking at is the $1 dividend divided by the 8%. And that's what we have. We see that the value of this firm per share is $12.50, given that it pays $1 in dividend at the end of each year forever. We always want to look at a company as being infinitely lived, because if a company was to last, say, we expect it to go on for 5 years, then we could backtrack and see that that company is really worth little today because it's worth very little tomorrow. It's worth even less the day after that. So there might be some valuation, but not much. Also keep in mind, as we look at this is the graphed out the net present value of that $1 at 8% interest rate over a long extended period of payments. Notice that it's increasing throughout until it gets to about the 50th year, and then it plateaus and it stops right around stops at exactly $12.50. And there's a pretty simple explanation for this. Here's where it plateaus, and the simple explanation is this: if you were to deposit $12.50 in a bank account that was paying 8% interest, each year you could withdraw $1 and not ever buy down or take out any of the principal of the $12.50. So eventually, over a long enough period of time, that present value simply plateaus at whatever it would be for the opportunity cost. It's also the other factor, too, that something 100 years down the road is worth very, very little to us today. We also want to look at the weighted average cost of capital. And what the weighted average cost of capital does is it measures or it equates our opportunity cost of different sources of borrowing. For example, let's say you're considering the purchase of a furniture business, and you've calculated that the firm earns $300,000 in profit each year, and that's not going to grow at all. That's going to remain $300,000 forever. You have a bank willing to lend you 60% of the purchase price for a 7% annual percentage rate. You have friends and family, they're going to finance the remaining 40%, and their opportunity cost of using capital is 11%. In other words, they're withdrawing money to lend to you or to invest in your company, and they're giving up an 11% return, so they require at least an 11% return on this investment. What is the most you should pay for the business? First, the weighted average cost of capital, again, it's just that. It's the weighted average cost of borrowing. So 60% of financing is going to come from the bank at 7%. 40% of the financing is going to come from friends and family with an 11% return. And therefore, we'd say the weighted average cost of this borrowing is 7.5% per year. And we can take that, the $300,000 profit, divided by our weighted average cost of capital, and see that we wouldn't be willing to pay anything more than $4 million for this furniture company. That becomes the maximum amount we want to pay. What happens now if we expect the furniture profits to grow each year, let's say by 5%? Now we want to use the dividend growth formula. And in this case here, the profit growth formula, dividend is profit per share. We're looking at the overall profit of $300,000 for this furniture company. And if it's going to grow by 5%, G represents that growth rate, 5%. R represents our weighted average cost of capital. And therefore, we want to ask this following question. This same firm, $300,000 profit per year, is expected to grow by 5%. What is the maximum you would be willing to pay given the weighted average cost of capital of 7.5%? Pause the video, go ahead and figure that out. We'll come back to it. Okay, Your answer should be $12,600,000. The $300,000 profit is going to grow by 5% a year. Dividing that by the weighted average cost of capital minus the interest rate gives us $12,600,000. Now, one thing to keep in mind with this formula, we always are assuming that the growth rate is going to be less than our opportunity cost of capital, the weighted average cost of capital. Some use the CAPM for this evaluation instead of the weighted average cost of capital. I'm using this to get some idea of just a simplified version of evaluating a company. The other thing we look at too is we assume that the growth rate is constant at 5%. That may change. If any of these do happen, then we have to use a more complex formula which builds it in stages or in steps. This is just a very simplified version, assuming everything is the same. Question number 7, assuming what we just figured out, $12,600,000 evaluation of that firm. What if the assets of the firm are worth $15 million? What does this tell you about the social value of this firm? So in other words, its capitalization value is $12,600,000. Its asset value is $15 million. What does that tell you? What it does tell us that the firm is wasting resources or mismanaging resources, that the value of these resources are better utilized in some other capacity other than in this furniture company. And how you can profit from it is simply buying up the assets and turning around and selling it or splitting up the company for its assets. This brings us to what's called Tobin's Q. James Tobin calculated that the market value of a firm divided by the replacement cost of its assets, including its cash, etc., if that's less than 1, then the firm is wasting resources. If it's greater than 1, it can be utilizing them. Of course, that depends on other factors. But anything less than 1, then the firm is being wasted. And this is shown in a great movie called Other People's Money with Danny DeVito, where he is he called Larry the Liquidator. He steps in and buys companies and sells them off for their parts, making a profit. He's taking companies that are actually wasting resources. Question number 8. You were one of the sharks on Shark Tank. Someone comes in asking for $200,000 for a 10% share of their company. They claim the profit for the company this year is $100,000 and that it's expected to grow 4% over the foreseeable future. Would you accept their offer if your weighted average cost of capital was 7.5%? So let's begin by looking at the valuation of the company. To ask you for $200,000 for a 10% ownership stake in the company, they're implying that the company is worth $2 million. 10% of $2 million is $200,000. Second, using our growth rate of 4% and the weighted average cost of your capital of 7.5%, then you would be willing to pay at most $2.97 million, which again is greater than $2 million, so yes, you can accept the offer. Question number 8, you're considering the purchase of an existing franchise restaurant, and you've calculated that there's a 20% chance that this restaurant will not do very well. Matter of fact, when you look at economic profit, you've actually failed because you're only bringing in $40,000 in profit, 20% of chance of that happening. There's a 60% chance that the annual profits will be $120,000. It's not bad, but it's certainly depending on what you're giving up for that. And then there's a 20% chance that the profits will be $350,000. It'll be a very, very successful restaurant. And these profit estimates are in perpetuity. What if you're waiting, and we're not going to do any growth on this, we're going to consider these profits are constant through time. What if your weighted average cost of capital is 7.5%? What is the most you'd be willing to pay for this franchise? And again, we want to take the expected value of the profits each year, so a 20% chance of $40,000 plus a 60% chance of $120,000 plus a 20% chance of $350,000. Our expected profit each year from this company, if this restaurant, is $150,000. We take the $150,000 divided by our weighted average cost of capital, and this franchise is worth $2 million to us. Now, what if you expected the profits to grow by 5% annually? Again, using our same formula we used before for the dividend growth formula, it's now worth $6,300,000 given that growth over 5%. This concludes our discussion on capital.